Using Fibonacci in a downtrending market, of course, we're looking for down price swings, and we must be able to distinguish the down price swings as the chart presents them to us. It's important for you to just get your eyes accustomed to being able to pull and apply the Fibonacci tools in both uptrends and downtrends, because you have to be very versatile with this tool. Because as we get into some of the more advanced techniques, we're going to be using Fibonacci's to make our trading decisions in both a combined uptrend and downtrend. Because again, as you know how we walk through price, there are uptrends within downtrends and downtrends within uptrends. And when we get into some of the more advanced applications, some ideal trading opportunities will present themselves when we are using a combination of uptrends and downtrends, and the extensions of an uptrend and the retracement levels of downtrends. So what I want you to do is simply get your eyes accustomed to the various price swings and how they complement one another. Taking a downswing here, if we start at a high, a downswing starts at a high and ends at a low. And as we see a low clearly established, we will watch price begin to retrace. And when we say retrace, we mean retrace on a percentage basis back up to this high. Price is retracing 38, 50, 62%, 79, and 100. In this example, I just bring the price swing to 62% retracement. We see price turn and extend to 127%. And as we so commonly see in these markets, price retraces again to the previous low, support becomes resistance, and price moves down to 162% extension. This is obviously an ideal scenario, and I only used 62% retracement as an example. Price could bounce at any one of these levels, but you may be asking yourself, well, how do we know which level it's going to bounce at? Well, that's where convergences come in. And we are looking for the level that is converging with a multitude of factors. And it may be the 30%, the 50, the 62, or the 79 that is converging with various other components that are more opportunistic in terms of where the market has a higher probability of bouncing. Looking at a real nice image here, again we see Australian dollar 2-hour chart, and price has been in this modest uptrend. We see price make a high, and from this high of 7,600 we watch price move distinctly lower, and you see how it moved right past this low. A move from this high from 7,600 down to 7,480, 120 pip a move is less common for the Australian dollar to move that directly in one shot. Now, once this low has been formed, then what we do is we'll pull our Fibonacci's from this high down to this low, establish our retracement levels, and here we see that the 38% retracement combines with the previous level of support. As well, this 38% retracement is also a central pivot point, and this is our 10-day moving average, which also is offering resistance to the market overall. When price retraced here, it really only gave us a couple of hours to get in, and I don't recall specifically how long price tested this 7,500 level at the time, or 7,520 level at the time. As we see, price move downwards, 127% extension. It stalls at the 162% extension. It consolidates before continuing its next leg down. As you recall, this is the first leg down of a key reversal move, and this would be the second leg down, and a significant one at that. Here are our price swings. Looking at a Euro 60-minute chart, several distinctive features on this chart. We see that the market has been in this nice uptrend. Resistance becomes support. It rallies to resistance and rejects, then moves and holds above this level of resistance. We see the market achieve a high on this day, 1027, consolidates into the following day, makes an attempt at the high and fails. A distinct railroad track, then a fade in buying interest, followed by active selling once price moved distinctively below. You see this level of consolidation here. When price started to move distinctively below that level of consolidation, we saw a nice reversal move down to the last level of support, which was resistance, support, support. At this point, we would pull our Fibonacci's when we see the low clearly established. We will pull our Fibonacci's from this high down to this low. That way, as liquidity picks up, we will start to look for areas at which price or the market could bounce. Here we see a distinct line of resistance and support aligning itself with the 38% retracement, which is also the central pivot point for the day. As well, however, we see that the 62% retracement level also aligns itself with a level of support and resistance. Now the decision you have to make as a trader is, do I want to watch to see what price action is going to do in and around the 38% retracement and try trading it there with a protective stop either above the 38, the 50, or the 62, or will I want to wait until sometime late in the session as price may retrace all the way to the 62% retracement because it is in alignment with this left shoulder of this overall head and shoulders, and it's a 62% retracement and a support resistance level overall. That's a decision that you have to make as a trader. And what you will do is you'll use your various techniques. Because this is a 60-minute chart, we can magnify this to a 15-minute chart, and you will use your skills and your techniques using your other tools in order to help you to make wise and discerning decisions at this point. Personally, I do distinctly recall this situation, and I don't want to be boastful, but my fill was very good in this scenario. However, it was my first line of business to manage my trade in such a way that I took some profit before we broke through these lows because price could simply swing within this range and continue up to the 162% retracement. Remember, the market can do whatever it wants. It can move up, down, or sideways, and it can do absolutely whatever it wants. It is not operating on your time. It is operating on its own time. And that is one of the most difficult challenges that traders have. Traders have a preconceived idea or timing of the allowable time or the constraints within which you want to operate from a time perspective, but we have to be completely submissive and adaptable to the timing that the market is going to prevail or to undertake. And if we can adapt and be patient with working with the timing of the market, then you have achieved and you have overcome a great battle, because that is one of the greatest challenges that traders have. The reason why this is, and I'm going off on a sidebar tangent here, but it's very important, is because that in our own lives we do things in our own timing, unless of course you have kids. But we do things in our own timing. And we are used to doing things in our own timing, and when we are inconvenienced, we become upset and discouraged and somewhat contentious. But with the market, we have to be submissive, and we're, as human beings, we don't like to be submissive, but we have to be submissive to the market's timing. Yet we have to be ingenious and discerning at the same time, and patient. And when we can discern what the market is doing in its timing and manage our trades accordingly, you will be exceedingly profitable. And please note this, and please abide by this concept and move out of your comfort zone and your own timing and your own selfish and self-centered manner in which you conduct your business, and move with the market's timing. And if you do so, you will be profitable. Now, we see price bounce to the 38% retracement, come down to the 162% extension, and we see a real nice retracement right back to the last level of support. And look at the bounce it takes. It takes a 40 pip bounce. Trading into this level of support gave you 40 pips to work with to make some money out of. Just that small move alone. It doesn't have to be a picture perfect and beautiful setup. It just has to make sense by following the rules of the market. All right. Furthermore, this occurs during Asian session. You see this vertical line here. This is the quieter time. This is getting near 0 hours, 0-100 hours GMT, and the Asian trading session. And the Asian trading session will absolutely respect these levels. Let's look at it from a, let's step back a little bit and look at it from a broader perspective, because the market will do something that can be very confusing to you, and we're going to look at this. First of all, let's look at this small head and shoulders pattern, where we see a nice head and shoulders pattern set up. We see a spike up to the 62% retracement of this downswing, retracement 62%, and boom, a fall to 162%. On this last downswing, by the way, this is a 38% retracement and a central pivot point. I don't put it in here because there is just too much to make things a little bit busy looking. But what I want you to look at is this. You see how price continues to swing down here, and it gets into this messy consolidation. Taking away these Fibonacci's, if you are to pull up your charts and you see this messy consolidation and you want to make sense of it, you may be struggling where to pull your fibs and what tools to apply within this messy area. Then what you want to do is this. You want to step back, and you see here how I've compressed this chart so that we see more data compressed into a narrow region. You can either take a 60-minute chart and compress it, or you can take a 2-hour chart or a 4-hour chart and look at the carte blanche. But what I want you to look at is this. As you see from this high, and if you pull your Fibonacci's down to this low, we see how on a retracement level that this 38% retracement level is capping the consolidation. This is quite common. Not only is it common, but if this 38% retracement remains intact, we still remain in a very aggressive market in the bigger picture. Well, look what happens as time elapses over a period of several days. As time elapses, we have a 38% retracement now converging with a 10-day moving average, and you see this previous high over here. Did you look at your lesson at support and resistance? Did you watch that lesson? Did you listen to it closely, or did you just bypass it thinking you already know about that stuff? Or did you listen to every word? Boring as it may seem, we're going to reinforce this lesson as we continue, because why is this level important? Well, if the major flows are watching these levels, because I see it every day, folks. I see every day the major flows and the distinct characteristic and the distinct manner in which the flows shift at these levels of resistance and support and distinct highs, because there's a reason for them. These levels are distinct because the price is a reflection of their view of what's happening in the changes in the economic environment at the time. And if that is their view of the shifts, and if they believe that this currency cross is not does not warrant a value greater than, in this case, 120.80, then they're going to do what they can to protect that price. Not only that, is they're going to protect positions that they're currently holding, be it speculative positions or otherwise, as well as the CTAs and the investment arms in the market. As you remember, as you may recall, one of the very first sections talks about the largest contributors to the market, and that is the CTAs and insurance companies, which move their funds through the banks. Therefore, if they're respecting these levels, then I want to also be respecting these levels and watching for bounces in and about these levels, both on a flows basis, but also on a technical basis, be it the 38% retracement, previous high, and the 10-day moving average, which I simply deem as a simple moving average as important. We see that this holds as a range high and price continues to move lower down to the 127% extension before consolidating after a generous move. Please reread your notes on the side here to help you to make sense of the market, and make notes on some of the things that I'm saying, because I don't want you to forget them. As you see here, we have a small price swings within larger price swings. So what I want to do is scale back and look at the larger price swing and the smaller constituents therein. Having a closer look at that head and shoulders, we see a distinct high here at the 10-day moving average as a resistance level. So if we see a head and shoulders forming at a distinct resistance level as established by this 10-day moving average, we see the 62% retracement and extending to 162%, and we see it struggle to move below these lows. But once it distinctly moved below the lows, we saw simply a decline in buying pressure here, and then we saw a conversion to selling as we saw the rapid movement below those lows. Important point. It's not always going to be picture perfect, but this is quite nice. This is a kind of a non-symmetrical head and shoulders pattern, but it is a key reversal day nonetheless. And what did I say about key reversal days? I said that the second leg is often the strongest leg, and a generous leg at that, and you should be prepared to trade it. We see price here attempting to move above this high, and it modestly does so before getting rejected. And the rejection, these rejections can really go. So this rejection, it comes down, and on an intraday basis, we see here that these two vertical lines represent one 24-hour period. And in the Central European session, we see a rejection and a price move down into the New York session. Then price consolidates into the following day. Now the following day, price, the Asian session does not take it below, but remains consolidative. But it's capped by the 38% retracement. Now, what's important about this capping of the 38% retracement is I believe it to be less likely to go to 50 or 62 or even higher, largely because of this level of support that exists here, and also because this is a central pivot point on this downswing. So if we were to calculate our pivots here on the 19th and move them over, our central pivot point aligns itself with the 38% retracement. It's not drawn in here because we don't want too many confusing lines, and also because this is a section on Fibonacci, and I just want to point that out. Then we see what leg? What leg do we see moving down? We see the second leg moving down, and an easing at the 127% extension, and then an exhaustion at the 162% extension. What happens at the 162% extension? And let me tell you that this is a trade in and of itself. Look at this. In one full day, price comes all the way down here. Now we're in Asian session moving into the following day. Look what happens during Asia. What did I say? It is typically unlikely to move below previous lows. Look at the lows that are established here. Sharp lows nonetheless. If I saw Asia trading and moving below these lows, I'd sit here like a hungry wolf, and I would be stalking this trade, and I would watch, and I'd say, come on. And look at this move from 2880 all the way down to 2800, an 80 pip move, making a go at these lows at a very thinly traded time in the market. I would be licking my chops here, and I would go long straight into that bearish candle, anticipating that there's a very low probability price is going to move lower than these lows. Although I'm trading into an aggressive downtrend and head and shoulders at that, I can capture some nice pips here on the retracement. And look at it, gave you 60 pips to take first profit. So if you can get 20 or 30 out of that 60 before it actually consolidates and moves higher uh, in that session as a retracement on a retracement basis for the following day.